What's up, everybody? I've made some major changes to my portfolio, and I have now bought $90,000 of Amazon. They report earnings after the market closes today. I'm going to tell you exactly why I bought $90,000 of Amazon. I'm going to tell you what I expect to come from earnings. And I'm even going to compare and share some valuations from Morningstar and then how I think about the valuation of the stock. Here's my Substack, austin.substack.com. I just wrote this to my email subscribers, so check that out in the link below if you want to read the whole thing. But I'm going to hit some of the high points here, and then we're going to dig into some of the financials and then Morningstar's outlook for the stock as well. Obviously, none of this is financial advice. I'm not a financial advisor. You can lose money. There's a bunch of risks. Do your own research. Don't copy what I do. But sometimes the best opportunity, I think, is staring you right in the face. And Amazon is a mega cap company that's been around for a long time. A lot of negative sentiment around the stock right now, and it's certainly not one of the most exciting names out there that you hear everybody talk about and all excited about. So I think this is a good opportunity for a large investment for myself in Amazon. I do think the NASDAQ and the S&P 500 are overvalued, and I think we're going to enter a recession sometime in 2023 and 2024. I don't think that stuff is priced into the market, and I think that we will see a downturn in the market. I just don't know when and from what point that's going to happen. It could be as early as next week when the Fed comes out with their next rate decision. That could be a shock to the market. We'll see. But what I do know is we have seen Microsoft, Google, Meta all report earnings. And for Microsoft and Google, their cloud results were better than expected. People were fearing more of a slowdown than what happened. I think that's good for Amazon. And then Meta did pretty good in their advertising segments, which Amazon has a pretty big and fast growing advertising business as well. So again, they report earnings this afternoon. I just shared a screenshot. Again, all of these are accessible. The link down in the description, austin.substack.com, if you want to actually see these things and be able to see all the screenshots and keep them. This is the value of the portfolio. We're up $18,000 year to date, about 17%. And here's the current portfolio for anyone who's wondering. Yes, there's been changes. No, I have not announced every single one of them on YouTube. That's tough to do. But I share them all in the email newsletter because it's easier to send an email than make it a YouTube video. But I do provide updates here on YouTube. Anyways, you can see Amazon is a $90,000 position. I've got Harrow Health, Perimeter Solutions, CNX Resources, Lithia Motors, Atcor, and MedPace. These are all, small to smallish medium cap companies. And I just think there's a lot of upside in them over the future. They could all drop a lot if the market takes a downturn as well. Who knows? But here's what I like about Amazon. Again, talked about the strength from Google and Azure. But these are some quotes from some industry expert and consultant interviews that I think show that their customers, and the cloud migration is still happening. Customers are still moving to the cloud. There's a lot left in that, moving from on-premise and managing their own servers and hosting and solutions to the cloud where they can rent from AWS or from Google or from Azure and essentially have them run and manage the services, and they just rent it every month, right? So that's still happening. It's clear that customers are prioritizing projects. They're cutting back a little bit, and they're trying to optimize where they're spending. So I think that's still bad for companies like Datadog and MongoDB, who are cloud companies and offer important cloud solutions. But when customers are cutting down and trying to consolidate and save money, I think it's more likely they're going to keep their spending with Google Cloud, Microsoft Azure, and AWS, and cut back on some of the extra stuff that they might have been planning to do with people like Datadog and MongoDB and companies like that. I think they'll be fine long term. I just think the stocks are potentially overvalued right now. That's why I feel good about AWS over Datadog right now. And then here's some quotes from Amazon on their last earnings call, and I won't read these whole things, but they just talk about how they're still on a good growth trajectory. They think their retail sales business is doing okay. AWS is on a strong foundation. Advertising is on a strong foundation. And what they're talking about a lot here is cutting costs and improving operating margins and growing operating income. And I think that is what's going to ultimately be what could send the stock higher after earnings, is things not being as bad as people fear, and then significant improvements in operating income as Amazon really starts to focus on cutting costs. Okay, this is their operating income chart. This is from stockunlock.com. We see it was way up in 2020, 2021. That's kind of artificial where everything just went online. But then it's trended down, and now it's down below where it was back even in 2019. What I think is going to happen is we're going to normalize an operating income back to around the 2018, 2019 levels, which are much higher than now. And I think that's going to be good for the stock price as the company optimizes. And this is just another chart that shows Amazon's not a dying company. Its three most important and highest margin business segments, AWS, advertising, and subscription services, are growing at impressive rates given their size, right? So you can see since 2019, advertising has grown 45% compound annual growth rate. Subscription services, 16%, and then AWS, 31%. And yes, they got that COVID bump. It slowed down a little bit, but I think we're going to get back to some decent growth as they come off some of these harder comps. And after we get through some of these unknowns with Fed, with rates and all that stuff, from a valuation perspective, Amazon looks very reasonably valued. The blue line on this fast graphs chart right here shows Amazon's average price operating cash flow ratio of 2013 at 26. So here's the blue line, normal price operating cash flow ratio 26. Right now it's trading at 19, basically 19. That's this black line right here. So it is trading at a discount to its historical valuation, unlike other more expensive tech stocks like Apple and Microsoft. And so I think Amazon likely won't jump back up to that 26 price operating cash flow ratio, but it doesn't have to. Even if they just stay at 19 and they hit the analyst expectations for operating cash flow growth through 2025, you're looking at a potential 126% total return for 35% annualized. And that could start this quarter. We'll see. I could be completely wrong about this, but even if I'm wrong on this quarter, then I've got a bunch of money invested in a stock that's been around for a really long time, done really well, changed the world. I don't really fear this company going out of business. And so even if I'm wrong on this quarter and Amazon drops 10% or whatever, over the long run, I think I'm okay having money invested in Amazon. I think it would recover at some point. That's kind of how I'm thinking about it. I'm still negative on the markets overall. I think that, the market is overvalued right now. I think the market is playing to this narrative that the Fed is going to have to lower interest rates. I think, unfortunately, what we're going to see next week when the Fed makes the rate decision is that they may not lower them as fast as the market is hoping. And that could be kind of a negative shock to the market. We'll see. Could be wrong on that, but we'll talk about that in future videos. A couple memos I linked here, Sea Change from Howard Marks talks about the different environment with interest rates, and then an update on kind of performing credit and how things are playing out right now. And then we'll just take a look at Morningstar, right? I shared my, thought and valuation ideas. They get a 4-star rating, and Morningstar has the fair value at $137, which is about 23% higher, 25% higher from here. So, or from the last close at least, right? So Morningstar thinks it's undervalued. I think it's undervalued. And I just wanted to share what I'm doing with my own portfolio. Let me know in the comments what you think about this Amazon trade. If you've made any changes in your portfolio, if you have any stocks that you want me to review, I like to do stock reviews on this channel. So just drop it in the comments. I'll try to review it. And then check out my email newsletter, austin.substack.com, if you want emails in your inbox and charts and an update of everything that I do in my portfolio. We'll see you next time. Have a great day and good luck out there.